What if I told you that the very ETFs paying you those juicy 12% or 15% dividends are slowly eating away at your actual investment? Most dividend investors don't realize that high yield often comes at the cost of NAV erosion, the value of your portfolio slipping while the payouts look impressive. Quick reminder before we go further, yield and tax treatments can change, and past returns don't guarantee future results. Here's the real surprise. I've found 15 ETFs that have delivered high income from day one and are actually up on their max timeframe price return, with no sign of long-term NAV decay. This list is built from ETFs that have not only historically paid strong distributions, but also shown growth in price performance since inception. Stick around until the end, because I'll be naming my single top pick. Now, before diving into those ETFs, we need to talk about a mistake most investors never see coming: the high yield trap that quietly destroys portfolios. The high yield trap most investors overlook starts with a simple misconception. The bigger the dividend, the better the outcome. Seeing a fund advertise a 12% or 15% yield feels compelling. Who wouldn't want consistent, oversized monthly income? But what isn't obvious is that those payments may be eroding the very capital you're trying to protect. A yield trap occurs when a fund promises eye-catching distributions but funds them in ways that reduce long-term value. Instead of generating cash from genuine earnings, some ETFs sell portions of their own holdings or return part of your initial investment back to you. On paper, it looks like steady income. In reality, this practice, often categorized as return of capital or ROC, cuts into the structural base of the fund. Over time, that leads to NAV erosion, meaning the shares lose value even when the dividend checks keep landing. This is where the danger becomes clear. You could faithfully collect distributions for years, believing you're building wealth, only to find your fund's net asset value has steadily weathered away. Mortgage REITs and certain leveraged credit funds are textbook examples of this pattern. They offer mouth-watering yields, but the long-term chart reveals continual NAV decline. What looks rewarding on a monthly basis ends in disappointment when you tally the total return. The emotional risk is easy to miss. Regular income gives investors a sense of security, creating the impression that their portfolio is thriving. But if that income is funded by selling pieces of the portfolio itself, you're not growing wealth, you're slowly shrinking it. It feels like getting richer in the moment while quietly losing ground beneath your feet. Not all high-yield ETFs rely on this damaging structure, though. Some strategies generate distributions by writing options or using derivatives that harvest premiums. The key difference is that these payouts come from market strategies designed to produce new cash flow, not from dismantling the existing portfolio. That distinction matters enormously when you're evaluating which high-income fund may serve as an actual wealth builder rather than a temporary sugar rush. So the takeaway is straightforward. Don't just look at the yield percentage. Always compare the current yield to the fund's price performance since inception. If the chart shows years of NAV erosion, the headline yield is masking a deeper problem. If the chart shows steady or positive growth while maintaining distributions, that's when the high yield actually means something for long-term wealth. In other words, income alone is not the finish line. Income plus capital stability is the real objective. And this brings us to the natural question most investors ask next. Are there ETFs that actually strike a balance? Is it possible to lock in strong monthly or quarterly cash flow while the portfolio value itself trends higher over time instead of drifting lower? That's exactly what we're about to explore. A group of ETFs that prove you don't always have to trade stability for income. Let's look directly at the funds that demonstrate it's possible to earn meaningful income while also seeing growth in your account balance. These ETFs have track records showing both distribution strength and price appreciation on their maximum time frame. JEPQ. This ETF provides NASDAQ 100 exposure using a covered call income strategy. On its max time frame, price return has been about plus 13%. while historically paying distributions in the 10 to 11% range. That combination of strong yield plus price appreciation makes it one of the most widely used options for income-focused investors looking at tech exposure. Keep in mind, though, those distribution rates are historical observations and can change over time. JEPI, in the same family as JEPQ, this fund gives investors exposure to large cap equities through a similar premium income strategy. Since inception, it has shown about plus 14 to 15% price return and paid a historical yield in the 8 to 9% range. Because it builds its distributions off companies with stable, large cap profiles rather than riskier or leveraged positions. JEPI has attracted many income-focused investors who want durability backing their payouts. JEPI demonstrates a core principle that you don't always have to sacrifice capital stability to secure regular income. BALI, officially the iShares Advantage Large Cap Income ETF. BALI has quietly produced one of the strongest performances in this group. Its max timeframe price return is about plus 25%, and it has delivered an estimated yield in the 8 to 9% range over that same period. Despite not having the same recognition as JEPQ or JEPI, BALI's combination of solid income and negotiable price growth makes it a less discussed but credible option worth attention. That relative lack of attention often positions funds like this as intriguing sleeper additions to an income portfolio. In practice, what sets ETFs like these apart is their structure. The core holdings are anchored in established large cap stocks or indices such as the NASDAQ 100, giving them fundamental stability during market cycles. The yield comes not from cutting into the portfolio, but from option strategies layered on top of these holdings. Covered call writing and related strategies generate cash flow repeatedly, creating distributions without dismantling the underlying asset base. That's why, instead of eroding NAV year after year, these funds have actually appreciated while producing high levels of income. Take JEPQ as an example. Investors have participated in the broad upside of the NASDAQ while receiving a double-digit distribution stream. Pair that with JEPI's consistent income from large cap equities, or BALI's strong total return profile, and the pattern becomes clear. These funds rely on repeatable income mechanisms that support the payout without undermining the portfolio's long-term foundation. For investors, that translates into a very different experience compared to the high-yield traps we covered earlier. Instead of watching monthly distributions disguised as regularly shrinking NAV, you can see dividend income come in while also tracking growth in the value of your shares. It shifts the outcome from wealth erosion to potential wealth building. Imagine reviewing your account and finding that not only did you collect distributions, but your total portfolio value trended higher. That is the real difference these income plus growth ETFs aim to deliver. And while the stability and income combination is already unusual in the high-yield space, there's another consideration that often makes just as much difference to your bottom line: how much of that income you actually keep after taxes. Because even strong yields can underwhelm once the IRS takes its share. More investors are starting to ask a deeper question: are there ETFs designed to pay high income while also structuring those distributions in a more tax-efficient way? That's where the next group of funds come in. Most investors think only about the size of the dividend when comparing funds. But there's another factor that changes how much income you actually take home: taxes. The IRS doesn't care how appealing a yield looks in a fact sheet. If that payout is treated as ordinary income, a large percentage might never make it into your pocket. Two ETFs can both advertise a yield near 12%, yet once taxes are applied, the gap in real returns can be wide. That's why some high-yield funds with tax-friendly structures stand out. Not only do they deliver strong distributions, but they also allow you to keep more of it each year. One example is the ProShares S&P 500 High Income ETF, ticker ISPY. This fund tracks exposure to the S&P 500 while paying close to a 12% annualized yield through high monthly distributions. ISPY doesn't receive much attention, often called a slept-on option. Yet it offers investors the credibility of S&P 500 exposure paired with double-digit income potential. Historically, ISPY's price gain has been modest compared to peers, but its appeal lies in combining steady income from a broad market index with the comfort of familiar large-cap holdings behind it. The NEOS S&P 500 High Income ETF, ticker SPYI, takes the high income concept much further. SPYI not only distributes close to 12% annually, it has also posted a price return of about plus 56% on its maximum time frame. That level of appreciation is rare for a yield-focused ETF, as many similar funds tend to remain flat or trend downward in price. With SPYI, investors are collecting steady monthly distributions, roughly 50 cents per share, while also seeing their underlying investments grow in value. A short comparison makes the difference clear. ISPY provides S&P 500 exposure with reliable cash flow and modest historical gains, while SPYI combines equally strong income with substantial long-term growth and an added tax advantage. That tax edge comes from how SPYI's payout is partially structured. A portion of its distribution is classified as return of capital, or ROC. Here's how this works. Instead of taxing the payout immediately like an ordinary dividend, the IRS lets you defer part of that bill by lowering your cost basis in the shares. In simple terms, you receive the cash flow today, but the taxation is delayed until you eventually sell the ETF. What that means in practice is extra flexibility. More income stays with you now, and you get to decide when to realize the taxable event. It's important to be clear about the trade-off with ROC. While it defers taxation, it reduces your cost basis, which can lead to higher capital gains when you sell. In other words, ROC doesn't erase taxes, it simply shifts them into the future. That timing advantage can be very valuable for compounding or reinvesting distributions, but it isn't a free pass. Contrast that with traditional dividends, which require you to pay taxes the same year they are received. If an ETF posts a 12% yield, but you lose a sizable portion to taxes right away, your real net return drops quickly. By comparison, SPYI's ROC component can be tax efficient in the short term because it lets you retain more of the income upfront. That difference can add up, especially for long-term holders who reinvest distributions. This combination of high yield, strong capital appreciation, and a tax deferral mechanism is what makes SPYI stand out. For income-focused investors, it shows that after-tax results matter even more than what's printed as a gross yield. Just remember, always verify the most current distribution breakdown before investing. ROC percentages vary over time, and both SPYI and ISPY may just adjust their tax classification depending on market conditions. The most practical step is to check each ETF's fact sheet or tax document before making a decision. High yield with tax-friendly advantages is a rare pairing in the ETF world, but it doesn't stop with broad market S&P 500 strategies. Some funds have gone further, building income-producing structures around sectors many investors think of only as growth plays. Can you really combine the fastest growing areas of the market with the kind of steady income usually reserved for dividend stocks? That's the promise behind a new wave of ETFs designed to transform volatility into high-growth assets like tech stocks and even Bitcoin into consistent cash flows. These strategies are built for investors who don't want to choose between long-term growth potential and immediate income. QDVO, Amplify CWP Growth and Income ETF, blends large-cap growth companies such as NVIDIA, Microsoft, and Apple with an integrated income approach. On the max timeframe, QDVO has delivered around plus 14 to 15% price return while producing a distribution rate close to 9%. This hybrid structure lets investors participate in tech growth trends while also collecting regular payouts. Instead of accepting that tech exposure is an all-or-nothing bet on appreciation, QDVO shows it can deliver compounding potential with meaningful cash flow along the way. QQQI, NEOS Nasdaq 100 High Income ETF, draws directly from the Nasdaq 100 and layers on a covered call program. It has returned roughly plus 5 to 5.5% on its max timeframe, with an observed distribution rate of almost 15%, equating to about 60 cents per share monthly. The appeal here is clear. Investors link their income to some of the most innovative companies in the world. A word of caution though, because the distributions come from option premiums, upside is capped during extreme bull runs, meaning you trade some growth for steadier income. GPIQ, Goldman Sachs Nasdaq 100 Premium Income ETF, is another ETF in this category. It shows about plus 40% total return on its max timeframe and generally distributes in the 8 to 10% range. Goldman's approach uses a dynamic covered call strategy, which allows partial participation in Nasdaq's upswings while collecting steady option premiums. This positions GPIQ differently from more rigid income funds, giving it flexibility to balance yield and growth. BTCI, NEOS Bitcoin High Income ETF, operates in a far more volatile space. It's returned roughly plus 3% since inception while distributing around 28%. For investors looking at Bitcoin, this structure takes raw volatility and reframes it into income. Similarly, BITY, the Amplified Bitcoin 2% Monthly Option Income Strategy ETF, has gained about plus 15% on its max timeframe, while distributing close to 25%. Both rely on option writings tied to Bitcoin's large moves, which generate outsized premiums returned to investors as regular distributions. But unlike equity-based income ETFs, crypto-linked strategies carry significant higher risk. They can produce eye-catching yields, but volatility remains extreme. The Roundhill Magnificent 7 Covered Call ETF, MAGQ, focuses on the most widely followed tech leaders: Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, and Tesla. It pays distributions at a striking 35% annualized rate, while returning about plus 6.2 since inception. Uniquely, distributions are made weekly, something rarely seen in the ETF world. But the high risk is higher too, since these 7 mega-cap stocks are among the most volatile equities in recent years. Alongside MAGQ is the Amplify Bitcoin Max Income ETF, which targets extremely high annualized option premiums, 30 to 60% according to the sponsor. As with all target yields, remember, these are objectives, not guarantees, and actual results vary with market conditions. Confirming fund names, tickers, and sponsor details is essential before investing, since early-stage strategies remain fluid. The common thread through all these ETFs, whether centered on leading tech stocks or high volatile crypto assets, is their use of covered call strategies. These funds sell options against their holdings and pass the premiums back to investors as distributions. This design monetizes volatility and creates income streams, but naturally limits upside potential in strong bull markets. That said, the trade-off is compelling for many investors. Steady cash flow from sectors usually considered growth only. The practical takeaway is that high growth and consistent income no longer have to exist in separate silos. ETFs like QDVO, QQQI, GPIQ, BTCI, and others show how combining structured income strategies with tech and crypto exposure is no longer just theoretical. It's happening now. Still, knowing how these approaches generate yield and what risks they involve is just as critical as chasing the headline distribution number. Because in the end, the real question isn't only whether an ETF distributes double-digit yields, it's whether that income stream is built to last while protecting or even growing your capital over time. So where does this all leave us? It comes down to identifying which funds really deliver sustainable income. My top pick from this list is SPYI, NEOS S&P 500 High Income ETF, because it combines roughly 56% max timeframe price return with about a 12% distribution rate and a significant ROC portion that defers tax. That pairing means immediate cash flow plus proven capital appreciation historically, something rare among high-yield ETFs. High yield is useful only if your capital holds up. Choose funds that pay and protect. Here are 3 simple takeaways. Prioritize ETFs with positive max timeframe price returns. Understand what portion of distributions are ROC versus ordinary income. And always verify the latest ticker details, yields, and fact sheets before investing. Numbers cited where the ETF's historical max timeframe price returns and distribution rates, both yield levels and tax treatment can change, so check the current documentation. Which ETF from this video would you research first, and why? Share your thoughts in the comments, and subscribe for more deeper analysis on these kinds of funds.